Once the bonds hit maturity, the US pays back the bondholder. Well, in a deficit situation, when these debts come due, the US doesn't have that money to pay back their debts, so they instead roll the debt over. They sell more bonds to pay off the old ones. But that's a problem in today's conditions because the previous debt would have been sold at very low interest rates, whereas now the debt needs to be refinanced at much higher interest rates. And what this means is that as more and more debts roll over, the amount of interest the US needs to pay each year rises, which increases their annual expenses, which makes the deficit worse. As we saw earlier, so far this fiscal year to date, interest has been the third largest expense category for the US. Since October 2023, they've spent $601 billion just on interest payments. And going back to the CBO's report, we can see that over the coming years, that number is only set to rise. They note that in 2025, interest costs are greater in relation to GDP than at any point since at least 1940, and are expected to rise to 4.1% of GDP by 2034, totaling 1/6 of all federal spending. And as you can see, with mandatory costs rising, this is going to greatly reduce the amount of discretionary spending the government could carry out, which naturally means tougher times, higher taxes, or taking on even more debt to cover the increased interest payments.